One, two, three, four.
What is up, everybody? Happy Thursday. My name is Mark. I have a YouTube channel called Uncultured Currency and Half Breed Observer. And this is my co-host.
Hey guys, I'm Mo from OTB Clubhouse.
Welcome, everybody. Thank you for stopping in. We're going to make this pretty quick, all right? We got a guest in the background, so we're going to just touch on some stuff real quick, less than 5 minutes, let the audience come in, and then we're going to get straight to our topic for today. So make sure you have a pen and paper ready, because today you're going to learn how to invest properly from an actual analyst. So first of all, Mo, how are your trades doing, man? We talked about trades last week. How are they doing?
I think, dude, we've been on point, and me and you do a pretty bad job about talking about that. So let's take a second here and talk about China and how well China's done. We called it before it actually happened, and I believe it still hasn't happened yet. I think China's got a lot more room to go, especially after Feds are pausing and the interest rate cut that China is doing. So a lot of good things coming China's way.
All right, yeah. So you spoke about NEO. I'm in NEO. I got into that today. I actually have cash secure puts. I have cash secure puts, some shares, and a $10 call. And then I have oh shit, I'm in QQQ. I didn't even realize that. Okay, I'm in a vertical bear spread for QQQ. So I'm up on that apparently. It expires tomorrow, 16%. In Lucid as a trade. XOP, if you guys took the XOP, you should be over at 50%. And then we got into Roblox today. My VIX absolutely tanked. That did not work out at all. The volatility didn't come in as planned, and that was a losing trade.
What calls did you have, if you don't mind?
Initially, 3 weeks, I think it was 2 or 3 weeks ago, I had gotten a $17 call when it was around $16. And then I added this Monday, I added a $15 when it was like a 14 something, and it did nothing. They both are down. I'm holding a 17 call, which expires tomorrow, just because I was like, I'm like down 88% or something. So it's whatever.
So and I'll tell you this, maybe you can do this again. I usually go at the money. So I have the 14 for June 21. They were up on Monday, so sold 80%.
Nice.
Only kept 20% just in case something happens. Question about Affirm. My goal for Affirm was $20, then 25. You have to understand, you can't play a firm like NVIDIA or Tesla. These stocks are very volatile. So It hit the 1970 range and went down. I think it's going to break out. Just see what's UPSD done. Affirm's going to follow. This isn't because Affirm's such an amazing stock. This is a lot to do with what's happening with small and mid caps and how they're getting squeezed. And I'll quickly cover one last one, and then we'll get going. KWEB. If you guys were on the live on Wednesday or today, they hit July 21st, 33, 34, 35 for close to 2 million in calls. I think China's going to start buying at night today. My goal is to open flat tomorrow for China so I could add more. I had a lot of stuff. I had CCL, I had Affirm, I had Shop. Shop's gone from 58 to 65. I think we get to 75. I'm starting to trim profits. FedEx is going, UPS is going. The only thing I'll warn you is watch the seasonality from here all the way till September, which we'll probably talk about it sometime soon. But back to you, Mark, and then I think we don't have enough time today. We're going to make sure we cover every single thing.
Yes, because we cover cash secure puts class. We cover cover call class. We had 2 people who do the wheel strategy, which is a combination of both of them. So we completed that series before. We're now going to start picking up a series on how to be a proper investor and how to analyze companies properly. And that's the reason I want to bring our today's guest on here, because this person killed it. He beat the market. Basically was a last year when everyone was down, he beat it by 20%. So, and this is no cap, no nothing. He's strictly an investor. So ladies and gentlemen, welcome Capital Mindset. What's going on, man? How you doing?
Hey, how you guys doing?
Yeah, first of all, thank you. Hey, it's true though, right? You beat the market last year. I know you don't like to brag. You're very humble. You don't like to talk about it, but it's true, right?
And we can talk about that with the topic of how to kind of spot people who are trying to grift.
Yes.
Usually, yeah. But that gets into that topic. But yeah, last year I did beat the market. So I eked out around a 22% return. And the market was, I think, down. I think it closed off between whatever time period you look at. If you measure from December to December or January to December, it's around 20% down was the S&P, I believe.
Yeah, so you actually
Around
did
that.
pretty well. And the year before that, I know you beat as well, and the year before that as well. So I mean, you've been doing pretty damn good
So
as
far,
you're.
but I don't want to jinx it.
Yes, so let's knock on wood.
Yeah.
But for our audience who does not know who you are, please tell people real quick who you are.
So I'm Fabio, but I have Capital Mindset, which is a YouTube channel I started for pretty much the sole purpose of trying to combat bad information here on YouTube. I was actually forced to start the YouTube channel by a good friend of mine who we would have conversations in basically our own private circles. And he said to me one day, he's like, you should really actually make a YouTube channel, because he was at that time, at that moment in time, following these other YouTube content creators who were providing what I believed and what he realized to be bad information at that time. So, because at the end of the day, YouTube is what I love about YouTube, and also what I kind of don't like about YouTube, but I accept, is that anyone can make content. And so you get a lot of good, you get a lot of the bad. The hope is that the good filters through. But at least in the early innings of YouTube, YouTube is also a momentum's game. So the ones who dominated are basically going to continue to dominate, because the algorithm floods all the new viewers who are, let's say you're just getting into finance and you go on YouTube. YouTube is more than likely going to recommend you the Meet Kevins of the world, the Jeremys of the world, etc., because they are the largest content creators. So
Absolutely. And then what's your finance background?
So I have a finance and accounting background. So I've worked now in both fields to some degree. In the accounting background, I was an auditor for a Big Four firm. In the finance background, I worked for a boutique private equity, and without getting into the name of current employers, but currently I do work in finance and as an analyst. So that's pretty much my professional background. As far as investing goes, I've been investing for now at a decade now. So I've been putting in about a decade. I wish I had more, but that's the whole point about investing. It's always a journey. Done well thus far, and built a strong community now, I think, through Capital Mindset, where it's a lot of like-minded investors. And there's people on there who make my dwarf, my okay. And I think that investing is all about aggregating information. So I like to think of my ability to talk to people who have more knowledge than me on certain topics and digest it, and then try to, from there, make decisions on that can hopefully make me money. So
got you. Yeah, appreciate it. So what do you got for us? I wanted to bring you on so you could try to actually break down how to properly analyze a company before investing into it. Sometimes I feel like we get too hyped on these stocks that are popular on Twitter or that you see in the news. But you actually have real experience how to break down companies. So please kind of give us a little, or educate us a little bit on how you analyze companies prior to investing into them, because you found some pretty good hitters of companies I've never heard of last year that did very well.
Yeah. So really I'll go on a high level, and then we can break it down and go a little bit more into the detail. Okay. But on a high level, what you're trying to do, first of all, let's focus on the mentality going into it. You have to break the mentality that a lot of retail investors don't come to the table, which is ownership in business. So it's funny when you talk to people, and it's really true. Buffett says it all the time, and I know it's like a tired mantra at this point because everyone says it, but it's different from hearing it over and over and over again and actually applying it. So people still don't apply it. And I still find people who repeat the words, but they don't follow the words, which is you have to think about investing into the stock market as ownership in businesses. So when you come to the table with that mentality, and you truly do, it helps you mitigate a lot of the mistakes that a new investor will make. So understanding that ownership mentality reminds you that, okay, what derives the value at the end of the day, okay? And hopefully it kind of steers you away from a lot of the hypey stuff, because you start to ask yourself, what is it that I own underneath this all? But going into that, so that's the psychology. That's not really any part of the fundamentals or pillars, but you have to first start there. So I look for durable competitive advantages. Now, that's just a funny phrase. What does that mean? Durable competitive advantage. That's just any business that for how it's designed, structured, or what it does is better at others, and you have to be able to identify why it is so. So every company is going to tell you that they have one, right? So
Yeah.
no one's going to say, oh, we do not have a durable competitive advantage. But you can look for things that tell you that they do have one. Okay, what are the things that tell you as an investor that the business you're looking at has a durable competitive advantage? You can look at, for example, sector growth, and they are growing faster than the sector. Okay, there's a quick example, high level. So if the sector is growing at 20%, but the company you're looking at is growing at 25, 30%, why is that? Why are they growing faster than the sector is growing? They probably have a very good product, very good service, etc. Another thing you can look at is their metrics like return on invested capital, right? That's like a little bit of a smell test as well. So for every dollar they're able to invest, they're able to generate a high return. That can tell you that, one, what they're doing, or it actually tells you multiple things. But sticking to this topic before we get into management quality, is they're probably involved in some sort of service or selling some sort of product that it has a lot of barriers for other competitors to come in. Because if you have a ton of competition, you're probably not going to have as much opportunity to generate as high margins. And that's a really good segue into margins. So margins is another kind of smell test that an investor can use to determine if a business has a durable competitive advantage. And how do those margins stack up over time? I'm going to give you guys a real world example. Everyone pull up at your own time, pull up Visa or MasterCard. Look at their net margins. And if you want to pull them up live right here, we can do that too.
Yeah. Do you have it? I mean, do you have it up on your screen? You can share.
Okay. Yeah. I'm going to go ahead and pull it up here. But Visa and MasterCard is usually the two companies I like to use as an example of two businesses. And I'm going to actually leave. Let me put you guys over here and then I'll share my screen. Okay. So we'll do. Yeah, this should be good. All right, let me see. Let me know if you can see that.
Okay, there you go.
So I'm using actually a free source. You can use this Seeking Alpha. It's not the best source, but it's good for this purpose. So you have Visa, and I left a couple other companies there that aren't necessarily comparable. So don't actually use them as comparisons. People make PayPal, Visa, MasterCard comparisons all the time. They're not really applicable. But Visa and MasterCard, what you'll notice as you go down here to the margin category or profitability category, you notice where is it? Net income margin right there. So 50% net income margins. That's absolutely ridiculous. You will not find many companies on this earth that have that level of margin. Then you look at MasterCard, similar story there. Actually, MasterCard's net margins, I think, have gone down a little bit because I think they used to be pretty close. And you can see the gross profit margin that I wouldn't really look at that all too much because that's more of the nature of what they are. The cost to deliver, this is more accounting terminology. The cost to deliver their service is very low. So MasterCard's gross profit margin is 100%. But that's because for them, what it costs to deliver the product, or the cost of sales, is practically zero. But look at that net income margin, and it tells you a really good story there. So that's getting into that. I love that word, story. So a lot about investing is actually developing a story. And when you actually work with, let's say, when you're delivering a pitch, right, and you're trying to explain to someone why this is a good investment. Let's say we're all business partners, and I'm trying to, sell you guys on an investment that we want to make. Well, part of that, my job in order to do that, is I have to come up with the story. The story is how you as an investor follow along and you get to the end conclusion of, do I buy, do I not buy? But that's also a very dangerous part that if we get into, I think, about social media, is that we can start to develop stories on weak foundations.
Yes, okay? I agree. A lot of people do that, like with Alex Karp a lot, Elon Musk, different situation, but I get what you're saying. Basically, you follow the story, but don't get too attached to the story because it may not actually equal to what's happening. behind closed doors.
That is when you're getting into, well, that's a really good segue into emotions in investing, where people fall in love with a company and they kind of put blinders on. So when there are red flags that show up, and if you want to know about the good stuff, we can also talk about red flags of companies. I know we wanted to get into red flags of content, but let me finish off with another thing that you could look for. And honestly, there's a lot of things to look for in a solid investment, but insider ownership. Let me caveat that because I put an asterisk on my notes here on purpose. But the caveat is, I don't blame a company if they don't have strong insider ownership. I would also, to be more detailed with this description, I want to know that the management has a lot of their net worth in the company. So if I see a company that, let's say the 50% of the company is owned by the CEO, but the CEO is worth 100 times more than the entire value of the company. Okay, that's example one. Example A. Example B, the CEO owns 1% of the company, but he has 90% of his net worth in the company. Which of the two do you think has a monetary desire, right, or incentive for the business to succeed the most? Probably example B versus example A. Even though the number, when you look at insider ownership, you're like, wow, the guy, example A, that guy owns 50%. That's what, people on YouTube say. That's high insider ownership. That must be great. No, not always, right? We want to be careful with that. So more detailed than that. So we want to see high insider ownership, but an asterisk around there. We want to see that the management team more specifically has a lot of skin in the game. Usually, if you see high insider ownership, that indicates that most of the net worth of the management team is in it, because people aren't worth literally tens of or hundreds of billions of dollars on a let's say outside of their business. So like Jeff Bezos, he's a worth over $100 billion. And you look at where all that wealth is, it's an Amazon stock. Jeff Bezos has a monetary incentive that Amazon does well. Elon Musk, same thing. So they're worth a lot, but they're still really highly incentivized to do so. And they still own a high portion of the business. So you want to look for that as well. But it's not like a definitive rule. You can find management teams that have small insider ownership, but they themselves are really tied to the success of the business. And they'll still do a good job. So I'll kind of lay it over to you guys. I don't want to ramble too much, but if you guys have any other.
No, you're doing pretty good. You got anything, Mo?
Yeah, I was going to say, you were talking about emotions, and I read the book, Psychology of Money, and they even talk about how people tend to fall in love with the stock. And, that usually happens because they have a position bias. One of the things I've noticed that, like, sometimes, because I'm a trader, and when I talk a lot of investors, one of the things that really throws them off is when I ask them is, at what point would you sell the stock or cut your losses? At what point would you change your thesis? And 90% of the time, people that are emotional, they get rattled, or their answer is very subjective. There is no objective metric they've put in to cut their losses, which tells me that they're very biased.
Yeah. And I'll kind of add, I guess, more examples or anecdotes to it. When I would make very negative videos back in 2021 or 2022, in the early days of Capital Mindset, that were contra to the narrative of a lot of these hype stocks, I got some negative comments. People are really invested in the success of these businesses, and to the point where they get angry if they hear a counter opinion. And anyone watching right now who gets angry to counter opinions, change your mindset on that. You should be very happy that someone posts a negative video about a stock you're heavily invested in. You should be very happy, because they're coming to the table with a different opinion than you. You want to hear their opinion. Now, it doesn't mean they're right. Doesn't mean they're wrong. That's a separate analysis that you have to make. But at least someone out there is giving you, and it's free information practically, a different perspective on your investment. And maybe they know something, or they're highlighting something that you didn't somehow know about. So it's more of a gift, but people get very emotionally tied up to their investments. And this is a main reason for why most retail underperforms. I believe that most people are capable deep down of becoming good investors, but they're strapped by, actually the counterpoint to that was like, well, that's their personality, therefore they're not capable of it. Okay, fair. But if you think that they're capable of change, or at least suppressing or controlling those emotions, then you can move on to the next step, which is, mastering that analysis. But
Good. So when you're analyzing a company, so you kind of talked about it top down, what are some things that you look on the, I guess, like the earnings statements, or like what are the main things that you look for?
Oh, easy. So when I'm looking at a business, the first couple things that I want to look at is, first, look at what can blow up, right? And that's kind of like the bond investor mentality. Look at what can blow up first. So look at the leverage. How leveraged are they? Because the only way a business can go bankrupt is if they owe more money than what they have or what they can produce. So go look at the leverage first, right? And so go look at that long-term debt. Go look at that current portion of long-term debt. So that's your liquidity and solvency ratios. Liquidity ratios, so I can expand on that, is your short-term health of the company. So things that are due within 1 year and what you have within 1 year to pay for those bills. And then solvency ratios are measuring the longer term picture. So what your longer term assets are compared to your long-term liabilities, right? Mm-hmm. So if you have a lot of debt, right, but let's say none of the debt is due until 50 years from now, which, by the way, Disney and Brookfield are two companies that issued debt 50 years. For 50 years. They don't have to pay back for 50 years. They did that during COVID.
Nice.
You try to do that. You can't do it. I can't do it. But those two companies did. And but basically, let's assume that. Well, then that's not an issue. So you owe $100 billion, and you let's say you don't borrow any more, but you only owe that at 50 billion. Sorry, that 100 billion in 50 years from now. Is it that much of a problem? Well, it depends on your operations, but that's context that gets added to it. You look at, your debt pile, and you see, okay, long-term debt of a couple billion. You have 10 million in cash. It's a couple billion, but you're generating a decent amount of cash flow. But if you look in the details, you find out, oh crap, a lot of that debt is maturing next year. Okay, well, what does that mean now? Well, you better hope that they're producing enough cash in the short term to pay down that debt, because what happens if they don't? Well, they can refinance. Why am I bringing that up? Refinance. I know I'm getting all over the place, but these are
Oh, did he freeze?
Yeah, I think I froze for a second, but refinancing is an important topic right now, because look what happened with interest rates. So if you're a business and your refinancing cycle fell within these couple years, well, you got really unlucky. If your refinancing cycle fell within 2020 and 2021, you were really, really, really lucky, because you were able to refinance that debt at really low rates. But now there's a lot of businesses out there that I point to that have revolving lines of credit. Let's point to Sleep Number Corporation is one that I can think of off the top of my head. Revolving line of credit, or a couple other businesses that you might find out there that have a lot of short-term debt or debt coming due, and they're going to have to refinance in a high interest rate environment, which is, for obvious reasons, unfavorable in comparison. And that's going to increase their interest expense, which lowers your earnings potential. So all that to be said, these are leverage is one of the first things you want to take a look at. It's the most important initial, I guess, analysis. Then you can kind of start looking at the operational side of things, and you can look at the operations within the income statement, and then you can also choose to accompany that with the statement of cash flows. So the statement of cash flows is non-GAAP. I know that there's almost like a mislabeling going on YouTube, because people are going,
with non-GAAP, right?
Non-GAAP and
Yeah.
GAAP.
Mhm.
And I hear sometimes people say that cash flow statement is a GAAP. It's what a GAAP allows. No, everything in the cash flow statement that's a non-GAAP. GAAP is referring to, when we're talking about income, is referring to the income statement, and it's or GAAP, by the way, is generally accepted accounting principles for those of you who may not know that. So when we're looking at the income statement, it's supposed to show us a more stabilized, real explanation of current business operations. People have complaints that GAAP doesn't or puts in a lot of non-cash expenses in there. And then people also complain about the cash flow statement because it doesn't take into account stock-based compensation, because stock-based compensation is a real expense. And if you want to go into a red flag, I actually have that down. If you see too much stock-based compensation, to increase cash flows, right? Because the cash flow figure will look better if you're using a lot, or you're paying a lot of your expenses with SBC. For the business, it's not cash that's leaving the business. For the investor, it's a real expense. So you do want to account for that. GAAP accounts for it, but the statement of cash flows does not account for it. So it's gives and takes. But
Can you give us an example? Can you run through like a specific stock real fast, pull something up and show us like how you would analyze it? For example, Disney.
all right, Disney. So I'll use the free service still.
Okay.
Yeah. By the way, it's not that it's completely free. Seeing Alpha has a premium version. I'm just saying you can see most of this stuff for free. But yeah, so if we're looking at, and I'm going to put it, on the left. I want to put it on the left. So first off, I'll start here to kind of tell me a story. Again, I'm looking for a story, assuming I don't know what Disney is, but hopefully you come to the business knowing already a little bit of context, or hopefully a lot of context actually, about the business, because you want to know first what they do. Again, going into that topics I covered, do they have a durable competitive advantage? And then we'll get into the other stuff about high ROIC, et cetera. But okay, so I see a story here. I see sales, right? That's a good place to start. Sales is going up and to the right, or in this case, to the left. And then I see the story of gross profit. Gross profit is telling me how much are they keeping after the expenses incurred to deliver their product or services. Well, now look what the story's telling me here. It's a lumpy story. It's not up and to the left here. So they went through, okay, what year was that? What year is this?
This is 2020.
Exactly. So then our mind should go, okay, what's the historical context? What was going on around there? COVID. So COVID happened, and you see a period, gross profit came down nicely. Not nicely, but you know what I mean?
Yeah.
It came down a bit. And then subsequently recovered. Okay, so we see this recovery, and the drop is explained a little bit by COVID. That's the context we need. There's a YouTube channel, Everything Money. They seem to have no ability for any context implementation whatsoever.
Shots thrown.
I'll throw some shots for entertainment. And then we have operating income, very similar story. Now, here's something interesting. So they haven't recovered. We see right over here the 14 billion that they experienced in 2018, subsequent 12 billion. Well, we'll give them that. $2 billion difference, $2.8 billion difference. That's not that bad. That's normal fluctuations. Suddenly, okay, but that's COVID. Why haven't they recovered all the way? Well, you start to tell the story. You look above the line item and you see, okay, well, there's this line item here, selling general administrative expenses. There's a lot of things piled in there. Basically, the administrative side of the business, and you could also argue the marketing side, so to speak, the selling side, so to speak, of their products, got a lot more expensive. It actually doubled throughout that time period. So this cost doubling made up for the fact that even though revenues went up. And context, what happened? So Disney Plus. So Disney Plus was a huge revenue growth driver for Disney, but it's also a very expensive product. So at the end of the day, the operating income we saw is now suppressed, relatively suppressed to historical comparisons. So we're right now looking at a business that is struggling. Okay, it's not doing so hot. And keep in mind, this was your red flag. I made videos on Disney negative before. I made negative videos on Disney, and you had this information back then to work with. You had this story playing out in front of you where Disney was growing sales and the market was loving it. But when you looked a little bit more under the hood, you started to see, okay, well, revenue's growing, but I can't pay my bills with revenue. The shareholder is not rewarded with revenue. The shareholder is rewarded with profit. The story here is telling me that the business is doing all these things to grow sales, but it's also increasing expenses at a faster rate. And so my profits are coming down. My operating profits are coming down. So the operational side of the business is deteriorating. Okay. And then we're going to talk about some other thing that they did that impacted them negatively. So then earnings from continuing operations, et cetera. But net income line item down here at the very bottom tells a very similar story. We didn't even have to get down to this line item to already tell this story. See, the key word I keep using is story, right? Because that's what I'm building out here is a story. So as you guys are all following along, it's because I'm telling it in a story. Hopefully I'm doing a good job by it.
You are.
You should be kind of deriving a story from what I'm saying, and that's helping you, stick along. This is always how you should pitch it to either a friend, a family member, put it in a story format. Okay, because it gives you the full explanation. Now we go to the balance sheet. So I'll talk right now and say I don't like Bob Iger as a CEO. That's a very controversial opinion because I do think Bob Iger from 2005, I believe, to 2015, he did really good things, but that doesn't take away from the destruction he incurred on Disney following that. So subsequent to that great time period, he destroyed the business or he harmed the business, and Bob Chapek took a lot of the fall for the mistakes of Bob Iger. He was the fall man. And Bob Iger did a lot of things. One of the things he did was I go down to, remember I talked about how you want to look at leverage. So this business used to operate at a much healthier clip or a much healthier stance, $17 billion in debt with about $4 billion in cash. And the size of the business was relatively the same to where it was today. So for that size, for Disney size, that was a very healthy balance sheet, extremely healthy. And actually they were commended for having a healthy balance sheet back then. Okay, well, they did some acquisitions, Fox acquisition, et cetera. And then COVID happened, and they borrowed even more money just to keep everything afloat. But that Fox acquisition was, I think, ill-timed. Ill-timed, granted, who knew that COVID would happen for them and et cetera, all that jazz. But the point is, this is actually where we get into another conversation about management teams' allocation of capital, which I alluded to earlier. Management, because you don't control the business, you are trusting the management team. So part of your homework should always be looking at management team. I have sold out of businesses completely because I disagree with what management is doing. Because why would I continue to invest in that business? It makes no sense for me because I can't change anything. I only have to just trust what they're doing. And if I disagree with it, I don't want to be a part of it. So Bob Iger's current plan, I agree with because it basically addresses all of my criticisms, but I still don't have faith or confidence in him necessarily as a CEO. And that's what's preventing me to making Disney a very big position. It's really that I don't have that level of trust or liking for Bob Iger. If there was someone else and I could make that determination that I liked them a lot, then we're in business and I would make Disney at the right price a very large position. But looking right here, you can see basically that, okay, they're paying down the debt, but the Disney of today is not the Disney of 2018. I hope that my story has illustrated that thus far.
Yeah, we see that the amount of money they spent and some of the mismanagement on their end of what they're doing, which I think they already mentioned on some of the earnings report as well. I remember reading an article stating that Bob Iger was saying that maybe they should just went to the licensing route like they were doing prior instead of starting at Disney Plus, because it is costing them a lot of money to put out content that is actually not being delivered at the quality that people are expecting. So they're losing money.
Precisely. And it's funny because Netflix has cracked the code. And I feel like it's a lot easier than people realize, but Disney is such a bloated business. Their bureaucracy inside of Disney is making them incapable of adapting to what really needs to happen. So Netflix in my portfolio, for anyone who doesn't know, is a pretty large position in my portfolio. And the vote of confidence I have in Netflix's strategy versus Disney. And by the way, let's talk about that for a second. When I went bullish on Netflix, I was not supported too much by the YouTube audience community.
Yeah.
There were who saw it, and anyone can go back and watch the video. I have a couple videos, and they're usually pretty long, but there's one that I posted that's almost an hour long. That's the DD. And so the DD was for free on YouTube. And I basically walked through the entire reason why I was buying Netflix when I was buying it. But yeah, it's a good watch.
And you bought, just so everyone knows, the reason why your position is big. And I was there. I was in your room when you did that. It was when Netflix dropped to, I think it was 150, correct?
Around there.
Yeah, I was not confident in Netflix. I still didn't think it was valued at a good price at that. You thought otherwise. Clearly panned out for you. I never invested into it, so that makes sense. I do want to touch on one thing real quick because there was a question in the chat. So you talked about stock-based compensation at first. On a balance sheet, where do you see that?
So you see, you won't. The quickest way actually for you to see it, especially like on a site like this, is actually just go to the statement of cash flows. So you'll see it right here very quickly. Statement of cash flows, and then you'll see stock-based compensation right there. Boom. Fastest way for you to find it.
All right, perfect.
Yeah. And so there you're seeing how much they are. So basically, because why are we doing this? So the theory behind this, or the thought process behind this, is it's a non-cash expense. So we're trying to reconcile it so that you're looking at only the cash that left or came out of the business. So $6.7 billion in cash is what Disney made from its operations. When you're looking at stock-based comp, that's an expense on the income statement, because it is a real expense, by the way. But we're adding it back because it's not actual money that is leaving the business. No cash, no dollar bills left. They just paid their employees in stock. So that's the reason why it's doing that. Some people think it's like supposed to be misleading or whatever. No. This is how it is supposed to be. As an investor, you might want to account for this. In finance, you'll learn there's nothing stopping you from being creative with your analysis. You can create your own ratios. You might value different metrics more than others. And this was when I was studying, right? The professor I had, a brilliant guy, encouraged us to create our own metrics. So he always said that you learn all these basic, you're tested on all these metrics, et cetera, creating all these ratios, and they're pretty basic. And then sometimes the formulas can get more and more complex as you progress. But the point of that is kind of just getting that level of mastery in the basics so that you understand the construction of them. And then you start to think creatively. And then you start to say, well, I want to look at this because I think this particular measure for that business is more important. And I'm going to create my little ratio and figure that out, or whatever desired formula you start to create. Basically, you use math, the math that you said, what am I ever going to use this for? You actually do use it.
Yeah.
But the point is you can start to get creative, but there's nothing misleading about, adding back stock-based comp. So it's my little gripe.
Awesome. Mo, you got anything?
I was going to ask you, so, you do your analysis. You're like, okay, Netflix, it looks good. Now, let's say you've allocated $1 million. That's how much your position will be in Netflix. How do you start scaling in? Do you do any technical analysis, or do you just like have a ratio that you start adding with?
So that's actually a good question, because to give everyone why this is actually sometimes the most difficult part of investing, more difficult than picking the investment, is allocation. Allocation is extremely important. And I'd argue, again, more important than the actual decision to invest. Okay, so where I go about it is I typically follow the same strategy. I break away from this sometimes because I'm human, and my audience has seen me do this before. And actually, I think the couple times that I broke away from this, they were flops. I think global payment systems, I added heavy in the beginning, and that one did not do well. I think I lost about 20% on that investment. But allocation heavy is, I think it was like a 5% at the time. So nothing too big in the grand scheme of things. But it was way heavier than what I thought. So going to your specific question about Netflix, what ended up doing that decision. So while I'm going through part of my analysis, I come to that determination as to what the target allocation will be, predicated on how confident I am in my evaluation. So that's more of a qualitative measure. So let me walk through pretty much what I thought about with Netflix. So Netflix, I came to a list of scenarios, and I actually walked through that in the videos, a list of scenarios that I believe the value of Netflix was at, or what I think I would acquire it for. I hardly ever do that, wait for it to get to that price point. And my audience, because that was the beauty of YouTube. That's why I love YouTube. It's a way of documenting this through video format. My audience, who's been watching me for a long time, will be able to tell anyone, oh, he actually bought Netflix. I think my first shares of Netflix I bought in the low 200s, like the very first ones. And then if you look at my cost basis, it's because I kind of just dipped my toes in. And I do have a lot of positions that I do that. And right now, the one I can point to is Humana. I had let's call it a toe dip position in Tyson Foods until the most recent drop. Then I made it into something actually meaningful. But I do that quite often, where I start acquiring where I think the price is reasonable or debatably fair value. And then as it gets to my more aggressive prices, I begin to scale into the position. I like to have the dry powder. And I have a philosophy that I'll prefer to wait. And if the position I bought in runs away from me, fine, there's other opportunities. So had I bought that small position in Netflix at the 200s or low 200s, and it just ran up to like 500 after that, fine, whatever. I'll hunt for something else. I will wait patiently for that opportunity. So that's where before we started the show, I said, in the big scheme of things, I don't make too many investments. I do make actually a lot of investments. So I can't say that I don't make a lot of investments, but I make maybe 2 to 3 big investments a year. And that's this year. One of them has been Amazon. That was one big investment that I have done. And then we'll see maybe if there's another one, but the one biggest one earlier was Amazon. So, by the way, if I know I go on tangents a lot, so if I didn't answer your question to your satisfaction, ask it again or ask it in a different way, because I don't know if I answered it.
No, you did. No, you did. I just wanted to see like how much technicals you're watching. I wanted to bring this up too because I see a lot of people, they don't understand how big position size is. Like you mentioned it, position size is, if anything, bigger than the actual picking of the stock, because position size is directly tied to your emotions too. You go too big, over leverage, and even if the stock will work in the long run, you might just cut it because you went too big and it dropped. So I just wanted to show, because I know you're off, of course you're scaling in, but I also wanted to know like how much attention you're paying to the price, because you seem to be someone who's like more like a fundamental trader, and you got to make sure like the fundamentals are good. And then I guess what you're doing then is matching it with the price of the stock to make sure that at this price, does it make sense or not? And then kind of have that gauge. Is that right?
Yes, correct.
Okay.
So
Mark, do you want to move to, should I ask the red flag question if you don't have any?
Go for it.
So the question that I have, and it's something that a lot of people like struggle with, we follow a lot of people, especially after 2020, and kind of the reason why we follow them is because a couple of their calls worked, and mostly they worked because everything was going up. Like if I told you right now that, oh, I invested in this stock, I'm up, I'm so smart, it's not really true, because everything's going up right now. In the last 6 months, you could have bought pretty much anything. Now, if you bought NVIDIA specifically in any chips, then, like you said, you had a competitive advantage, because compared to everything else, NVIDIA is up. Compared to everything else, Netflix is up. So that shows me that, you know what you're doing. But the question is more so on red flags. How do we avoid following these people or getting kind of like learning the wrong things? How can we catch this beforehand? Because once you're in it, it's already too late. How do you catch this before this happens? Like what kind of information are you scanning for these red flags?
And you're talking about red flags for the business, not the creator who's presenting the information.
Okay. It's for the creators.
Okay.
Yeah,
So
the clowns out there that will, right now it's like Netflix is awesome. You missed the boat. It's great right now. Buy now. Those clowns. What you're talking.
Like I'll give you an example.
Yeah.
We had someone, and I brought them up without saying their name. This is when we just got the recession, like not the recession. We started dipping, and Shopify was at like $800 at that point, and the person like, just buy. This is how we're gonna fight inflation. And I think if we take the split out, it went as low as 300 or even lower. And they kept telling people to buy from 800. So they were wrong at 87654. And eventually they are now right. So those kind of creators, the dodgy ones.
Yeah. And those guys, so the buy forever mentality is a bit problematic because you can still underperform the broader indices. Just because like if you're not taking this carefully, it only takes one big mistake. If I'm being real with you guys, it takes one big mistake, and then all your track record of outperformance, if it was just pure luck or degeneracy, well, that's gone. And that's all it really does take. And overconfidence is going to be your enemy in investing. I'll say a big red flag is when a creator is using their returns in any given name as kind of like the marketing tactic. Unfortunately, that's what it works, or that's what works. And people in my community have kind of we've having discussions about to counter that, or to try to let's say save some people. Maybe I should implement, unfortunately you can't beat them, join them kind of an approach, which I've been hesitant to do. But and let's take a specific example. Is that okay if I use specific names?
Go ahead.
Okay, so Jeremy from Financial Education, he's a great example of this kind of marketing strategy where he will use Tesla. Look at his story. Look at his Instagram story today, in fact. He will use Tesla. He'll post Tesla gains, and he has that one stock, right? And then he follows it up by his Patreon link, so that you pay him so that he can show you what he buys on Friday. He spends $150, buys what he wants on Friday. And there's plenty of people that want to give him money. He has like, I think over 7,000 patrons now, all paying him $10 a month. So there you go, 70,000 right there. And he's a great investor, apparently. But
tattoo chef.
Yeah. So he also will show his portfolio of like 1.6 million, and he used to have a 2-point-something million dollar portfolio, but he doesn't relay that information. He's hiding that information. That's targeting the new person. But let's say you don't know that. Let's say you just came across him for the first time, and you're like, okay, what are the red flags? Well, showing you a stock that he did really, really, really well in. Right, a single stock they did really, really well in, then followed up by some sort of promotional offer, saying, "Okay, now buy my course." Because there's something that's implied there. He's implying that he's an amazing investor, and that a lot of his stocks will perform like that, like Tesla, and it wasn't luck, and he will continue to do so. And he also has like another investment that did really well, which was ELF. But you see, like that's where we get back into allocation. And is it luck or is it skill? Because you can pick 1,000 stocks and you're going to have some that are really good, or you can pick a lot of stocks and you're going to have a lot that are really good. But in aggregate, how are you going to be doing over that long period of time? And that's where you're going to really be tested. And let's talk about another guy, Nash, Mr. Nash over there. So Nash is one that uses sometimes some interesting tactics where he'll talk about a ton of stocks, and then he'll highlight that one stock that went up, which I think he made a video on. I think the most recent time he did this was it Oracle? I think it was Oracle. But yeah, he made videos about tons of stocks. He doesn't talk about all the ones that went down, and he highlights the one that went up. And then again, followed by the implication that he's really good at what he does, et cetera, and you should be following him, and then also pay him, by the way. So they're very promotional is what I'm getting at. And they make money primarily from you giving them money, not from their investments. So I like to say as a joke, really cynical joke, Imagine a finance YouTuber that mainly makes their money from their investments. Oh, that's wild, right? That's crazy to think about, because nearly none of them do.
Yeah, you're one of the few ones. And shout out to Tom Nash. I'm actually he's one of my buddies, so I know you guys don't like him. I actually get along with Tom Nash pretty well.
He's
I
a
don't agree
nice
with him a lot.
guy.
Yeah, he is. He's a terrible investor. I already told him that, but him and we're cool. I think he's a generally good dude, but yeah, he's not
I've
the
seen
best.
like 10 tweets from him on just Palantir since.
Oh yeah, he's a Palantir simp. He's a Palantir simp, a Tesla simp, and I think a SoFi simp. I could be wrong about SoFi.
I don't want to say that you don't want to highlight your winners, because I mean, I don't do that. So if you go on my channel, I just say find the Meta videos that I spam Meta. Like I'm up 200 something percent on Meta now. I don't spam Meta videos. And in fact, I get questions, can you do a Meta video? And I literally just say, go watch my video I made on Meta in November. Nothing's changed.
Yeah. All right. Let's go through some questions real quick to see if anyone has any questions. Oh, okay. Here's Trey. It says, can we highlight this? Oh yeah, there you go. Here's one. What metric should one use to invest in a company while it's still not profitable, yet things are improving? I'm assuming he's probably talking about something, for example, like SoFi, which is a company that was not profitable for the longest time, completely tanked, and now it's kind of coming back because the market's coming back as well, but they're starting to turn things around. So what metrics do you use?
So with a non-profitable business, it becomes more nuanced, right? First, let's kind of say, does management currently have a target of profitability? Are they saying by X year we're going to be profitable? That's a good goalpost, right, to start with. And then now I want you to look at that company, and this is like, I can say it like this way because it's not really financial advice. This is more like homework. So you go find that business that you're thinking about, Trey, and you start to say, do they have a goalpost of when they're going to be profitable? Now start to judge them on that goalpost. Give them like a report card. This is like your management report card. Are they being, how are they doing to getting to that goal? That's one thing. Two, okay, so usually when a company's not profitable, they're going to be looked at in a different manner. They're going to be looked at for their growth. All right. And for the most part, you'll see time and time again, when a company that's not profitable and they're in their growth phase, if at any point in time that growth starts to slow down, what do you see the share price do? It craters, because the point is the market is rewarding them for taking market share and believing that profitability will come. And then you're going to get stuck up in that. And you need to understand that that is the narrative you're going to be playing by. There is no fundamental backbone to that business at that point in time. It's all future potential, because you're investing in a business that is not producing a profit. So you're writing a narrative. That's always going to be the case. Give me any unprofitable business and I will show you why you're writing a narrative. You are 100% writing a narrative. The narrative could be right though. Okay. Plenty of times we can point to companies where the narrative was in fact right. Amazon is a great example where they don't really show, for a long time, they didn't show profits. Mm-hmm. But Amazon's a weird one, because Amazon is a case of where you should have been paying attention to the cash flow. So they were cash flow positive way before they were net income positive. That segues into that. They may not be GAAP net income positive. They might be cash flow positive. Now, you don't stop there. You never stop there. Okay, how are they cash flow positive? Break that down, okay? Because sometimes they're cash flow positive, but like I was just describing earlier, when you look at their cash flow statement, you see a little sneaky stock-based compensation, and that's the only reason why they're cash flow positive. So if you remove that, they're cash flow negative. Oh, that changes the story right there. So that's something you want to pay attention to. So, you follow along that train, and that should help you to again build out that story. But they could be a very, very fast growing business. I want to say that you want to look at that durable competitive advantage in their moat. How is their gross profit? That's not where you should stop. How is their actual EBITDA margins, their operating margins, right? How are those doing? So you want to look at that.
All right, and we have one more question we're going to get to before we play the game. Then we're going to wrap it up. So here's another one from Trey. Trey always asks questions. That's good. All right. What are some unprofitable companies that Capital Mindset is looking at?
I want to see. Wait, let me make sure they are unprofitable because there's one that comes to mind, but I don't know if they're unprofitable. And they're an investment I have. Yeah, they're not profitable right now. So that would be Zillow Group. So Zillow, but they're small holding, but I technically own them. So there's one that I bought, and I'm actually up now on Zillow Group because I just checked the price. Yeah, 47. Heck yes. I'm trying to think of another business that I own that is currently unprofitable because none of my big investments are unprofitable. I think for unprofitable businesses, I tend to keep them more on the speculative side, but they do make it within my portfolio. I'm trying to think. I swear there's another one that's in there. There's some that were like temporarily unprofitable for like one-time reasons. Those don't count. I don't count those.
No worries. We could go.
I don't think so. I don't think I have many.
All right. By Charles, the Come Up series. What is your thoughts on Apple and Microsoft? How they continue to defy the gurus that their time is up?
Oh, for me?
Yes.
Okay, so I think that both are like the business. What you're looking at for both Microsoft and Apple in terms of returns is just multiple maintenance. What do I mean by that? So a lot of the returns you saw, Charles, with Apple and Microsoft was multiple expansion. If you, I don't know how long you've been investing, but I was just say if you were investing back in,
he's like 30, 40 years. He's been investing for quite some time.
So then in that case, I'll say recall to 2016. What was Apple's multiple at and what happened? Apple's multiple in 2016 was that it was like in the low teens. So what you see now is Apple's multiple, what is it at? 30, 25, somewhere in the maybe 20s. But point being, you saw earnings growth. It's not like you didn't see any earnings growth. You saw earnings growth, but you also saw the market reward Apple. So it was paying more for every new dollar that Apple was earning.
Mm-hmm.
So that multiple expansion was a huge part of that return. Same thing with Microsoft. You go back 2015, people weren't really touching Microsoft. The story was there. And now that they've executed on that story, the market is now saying, well, now they have one of the most durable, high profit businesses in the entire planet. And there's no one really coming for them. They also are at the head or forefront of this AI craze with ChatGPT or their ownership stake in OpenAI. So that also builds that narrative component to the investment. So you are basically going to make money here from multiple maintenance. But I don't usually like those setups. They can do well, by the way. In fact, most of the time, you'll see multiple maintenance and the businesses continue to grow. So if you believe that the market will always keep Microsoft and Apple in that quality bucket, that high quality bucket where everyone's always going to be willing to pay more for the same earnings that Apple's growing, even though their growth rate will come down. I know Apple's has come down. Then you should fairly do fine. You should basically expect a return in line with their EPS growth. That's more or less what you should be expecting as long as multiple maintains. If anything happens that the story starts to change, the loss potential is pretty insane. So with Microsoft, I can tell you if anything occurs that causes a chink in that narrative, not saying I see one, right? That's the point. We don't see it happening. We don't see it coming. Any chink, boom, you will see a significant drop in Microsoft because the setup just isn't very good. Meta was the reverse, where in November, I forget the exact day, but November 2022, the setup was beautiful, okay? Where the expectation was that Meta will fail. And then so all that Meta had to do was just not fail, not necessarily succeed, just not fail. So the setup was perfect. So you're in the opposite camp where everyone identifies that Microsoft is great. It's not a secret. And you're hoping that the market will continue to pay a really high premium. And then your return will be just, again, that growth of EPS. So.
All right, perfect. So we're going to wrap it up real quick with the game and we're closing out for the day. Do you have any other questions, Mo? Oh, you're muted, dude.
I'm good.
You good? All right, cool. Let's go to, all right. So this is how this game works. I'm gonna give you some tickers. Yay or nay? As in yay, you would invest into it. Nay, you would skip. All right. And if you don't have any idea, to say I don't know. All right, ready?
All right, I love it.
All right. AEHR. I don't know what that one is.
AE.
Yeah, he put 4 up here.
Oh, okay. Geez, I don't know any of these. Wait,
Yeah, I've never heard of
PSTG
it.
sounds familiar. Hold on. PSTG, that sounds familiar. That one sounds familiar. What is this one? Oh, Pure Storage. Yeah, I don't really have an opinion on any of these, but Pure Storage, I'd be cautious on. I think they're probably up because of the AI boom. Because if they're a digital storage, yeah, I don't really have good opinions on any of them, unfortunately.
Okay.
INTA, I think I was asked about that the other day, though. Let me just make sure it is this one. The insurance company? No, it's not.
Okay.
No, it's not.
Next, SoFi.
SoFi was okay. So
Just yay and nay. Just yay and nay.
was a yay for fun. Now it's a nay.
Okay. Tesla, of course.
Tesla's a nay. The setup is not good.
FRC.
That's a dead company. What?
I don't know why it's even there.
First Republic.
Rick.
Yay.
Okay. PayPal.
Yay.
Setup
is good.
What's another? I think Fuhad had one that he was asking in here.
Careful with Fuhads.
I know. Well, BurgerFi. That's a nay.
Nay.
I'll answer that right away. There was one Fuhad. Can you drop the ticker in again that you wanted Fabio to recover? So Netflix right now. Netflix.
Is there a neutral?
Okay, we could go
Neutral.
with that. AMD.
Neutral.
Palantir.
Neutral. Nay. No, nay. Nay
Okay.
for Palantir.
Target.
Close to yay.
Procter & Gamble. PG.
Nay.
All right, there's a Fuhat one. PPRUY.
First one I'll say nay. Second one I'll say neutral.
Neutral. Okay. Bug.
Never seen Bug. Let me see what Bug is again. Oh, global. Okay, so this is an ETF. Yay for that. Generally speaking, strong tailwinds. You're playing the whole system. So
okay, and I got Neo.
Nay, no, I don't touch Chinese.
Okay, we already did Tesla. This new company that just went IPO, Cava, CAVA. It went up 90% today.
Oh, then probably
It's
a nay.
brand new.
Immediately.
Everyone's saying it's going to be the new Chipotle.
Oh, well, I don't like companies that are the next something. Usually those historically don't turn out well, but I'll say if it went up 90%, definitely nay, especially if it recently IPO'd. I like to let things simmer out before I go in.
That's actually advice I give that person who asked. Best Buy.
Let me see what the price is right now because that it really does depend. Okay, kind of more in the getting close to yay.
Okay.
On that one.
Verizon.
Nay.
Louis Vuitton. LVMH.
That is almost. It's hard for me to say nay, but neutral. Wait, watch that one. Put that one on your watch list, everyone.
Okay. Coke, not Coca-Cola, but Coke, the bottling company. The
bottling company. Oh,
yeah.
No,
Coke.
that's
COKE.
It's borderline yay, but it's more neutral.
I love Coke. Apple.
Neutral to slightly nay.
Coin.
Nay.
Hood.
Nay.
AI.
Nay.
ENPH. Enphase.
Nay.
Wow. Citibank.
Very dangerous for retail. Neutral because they have a lot of unknown risk.
Okay.
And that's why they're so cheap all the time.
ZD. I don't know what that one is.
I don't remember ZD.
All right. And then last one from the audience, LHX.
Oh, that's a yay. Yeah.
Okay. And then DEC.
DEC. I don't remember this one. Let me look at the ticker real quick. DEC. Oh, Decker Outdoors. Neutral, slightly nay.
All right,
Because
Mo, do you have any that anyone asked you about?
I just find the tickers very funny. The people that I won't say much, but I know why people are picking those tickers. But okay, I'll give you two. We'll be quick. Shop.
Shop is a former love story of mine. What are they at right now? Because
65.
65, but that's like, I'll go off of market. Okay, actually, wow, it's come down a lot. That one's now leaning. I did not know they came down this much. Oh man, I wish someone had notified me.
I got
it
in
went
at
down to
59.
30.
I got in at 59. That's what I'm asking.
It's actually kind of leaning on that. Yay.
Yeah. Okay.
I'll give you a bad one in the sense that how much they've dropped. Affirm.
Oh no, nay.
I thought so.
Nay.
Okay. And then last one, Snowflake.
Good company. Valuations is terrible. Neutral.
All right. That is it. That is the end of the show. Listen, Fabio, thank you so much.
Yeah.
You know what? I'm gonna do something. I'm breaking the rules here. Mo doesn't know about this, so I didn't tell you, Mo, because I didn't want to get you in trouble. And there's a rule here on this channel: we don't sell products here, regardless if a person has a product or not. The thing is this: so many people have bought shitty courses, been part of a bunch of crappy Discords, trading groups, PowerPoint briefings that spent hundreds to thousands of dollars for. People have joined a stock club that cost $10,000 and learned absolutely nothing. You have a stock club. You have a stock club that's actually very valuable. You do meetings once a week, usually on a Sunday, where you would analyze stocks like we just did now, where I put it in there, but you actually analyze them. And I've seen you in the room anywhere between, on average, you're what, 2 to 3 hours? But you've been as long as 8 hours answering everyone's questions, analyzing companies, analyzing stocks, and going through the stuff. You literally get legitimate value from your community and your group for what you're doing in there. So we were not supposed to pitch stuff here, but I'm going to pitch your Discord group today. Listen, everybody, it's not for just one coffee. If you ditch one coffee a day, you could subscribe to him. No, it's if you ditch one coffee a month, you can join his official stock club where you will learn actual stuff. It is $5 a month. There you go. I'm putting it in the comments right there. You're more than welcome to sign up. Everyone, I think, is extremely valuable. It's only $5 a month. You get to have access to Fabio, like we just did. Everything you just saw him do here, he does on Sundays. What else do you get in your group?
You get also a Thursday stream, write-ups, and basically just the rest of the community, which is also really good to learn from the other members, because there's a lot of people in there who know their stuff.
Yeah, you have real financial accountants and analysts and stuff in your group as well. Your group is small, and you're not doing this to profit, because that $5 a month goes to who?
It basically goes to a lot of the management of the club itself. So any projects that we try to build out over time, it goes to that.
Yeah. So I'm putting it in there. You guys are more than welcome to sign up. Also, subscribe to Fabio's channel. He's got a really small channel, but it's growing. He just go through his stuff. He has a list. I think if you join the stock club, you have an Excel spreadsheet where you have the link to every single company that you have analyzed, which I think is over 100. Am I right?
It's definitely over. It's definitely over 100. I have to update that, but it's actually for. I think I have to update it and then post it again in my videos, because it's for everyone. It's supposed to help people navigate through my video library. So
okay, all right. So there, if you guys are interested in joining a real stock club, all right, not a fan club, not some BS, a real stock club where people really analyze companies and make you a better investor. $5 a month. No, me and Mo do not get a cut from it. Clearly, Fabio doesn't keep it himself. He doesn't need to. So if you want to join and learn some stuff, by all means, join a Discord group. There is some degeneracy that goes into the general chat as well. But for the most part, if you go there, sit in. I think it's just for your time that you sit down every single week to go over stocks. I think is very well worth it. So everyone, thank you so much for tuning in. Mo, you got anything?
Nope. I think we're good.
So listen, Fabio, seriously, thank you so much. Everyone, we'll see you next week. Please give us a thumbs up, subscribe, and share this with people out there who you think may need help to become a better investor. And let's continue to grow together. So until next time, y'all, my name is Mark with Half-Breed Observer / Uncultured Currency. Mo, where can they find you?
You can find me on OTB Clubhouse on Instagram. And I promised you guys I'll be doing lives every Wednesday at 2 p.m. PST. And then you can follow me on Twitter at OTB Sharkmo.
Yes, every Wednesday on Twitter and Instagram, right? Is where you go
Instagram
live.
mostly,
Yeah. And Fabio, where can they catch you?
You can find me on YouTube, pretty much, or in Discord.
Yeah, because you don't do
Mostly
Twitter
catch-
and Instagram like that, really, do you?
No, I don't. Unfortunately, I don't have time, but maybe one day.
All right. And just so you know, when you do join the stock club, you're not going to have access to him 24/7. He has a career. So don't ask simple questions, please. There's plenty of other educated people in there that are licensed and analysts who are willing to help. So until next time, y'all, peace out.
That's 100.